have a quorum, so first I'm going to I'd like to ask for a motion to approve the minutes of May 27th, 2026 meeting of the Finance Committee as presented.
So moved. So moved.
All in favor, say aye.
Aye.
Any opposed? Any abstentions? The motion passes. And I'm now going to turn over to Mr. Blake and Mr. Strickland from our friends from Clearstead for the quarterly investment committee report.
Thank you. Good afternoon to the committee and to the trustees. So what we have here today, we're going to have, if you go to the next slide, please. We're going to go through the agenda here, what we have for you today. And we're going to give our normal update on markets, performance, but the bulk of our conversation today will be on two managers that we're looking to replace within the international sleeve of the portfolio. So Adam will go through that. We'll also spend some time on the fixed income analysis, looking at the reserve and short-term pool. Given where markets are today, I think it's important in bulk of the assets for the system to review that in a little bit more detail. And then one of the key fiduciary items is the fee review that we'll finish with. If you go to the next slide, please. So this is an outline of our oversight dashboard. Key things here to look at is the previous quarter, we reviewed strategic asset allocation as well as investment policy. And then this quarter, as I mentioned, with key fiduciary item, we'll review fees. So let me just jump into markets on slide 5, please. Just taking a look at the second quarter results. You can see we really had a strong equity market returns in the second quarter, which is really driven and highly concentrated in tech and AI related names. So if you think about the first quarter of this year, we had a drawdown in equity markets. We saw that bounce back really, really strong. And so we actually had the best second quarter in equity markets since 2001. And you can see those results in that green box there in the second quarter and year-to-date returns. So the SP 500 was up 15% on the quarter. Russell 2000, representing the small cap stocks, was up 22%. MSCI EFI, International Develop, was up 11%. And then you had within bonds, representing Bloomberg US Ag, was slightly positive at 70 basis points. And so I want to spend a couple minutes. I think it's important to go through just how concentrated the market was. We go to the next slide, please, on slide 6. First, I'm going to look at the top half of this page. It shows you the bi-monthly returns of the S&P 500, looking at this historically over the past 100 years. And what this is showing you here is that April and May alone really saw that sharp rally in equity markets. You can see the bi-monthly return for those 2 months alone were 16%. So that was the 99th percentile of 2-month returns going back 100 years. I think it's really important to look at the bottom half of this page, which shows you the performance of the top 10 stocks in the first half of the year. And I want to really just hit on the point that it was really concentrated. So 73% of the S&P 500 returns in the first half of the year were counted by 10 stocks alone. And you can look at some of those names. They're all AI related, semiconductor related. SanDisk was up 858%. Micron was up 305. So some of those similar names that you've seen. And so if you go to the next page, this gives you just in terms of market concentration by weighting. And you can see, if you take a look at the S&P 500, those top 10 stocks equate for almost 40% of the index. So really concentrated market, narrow leadership, and really what we're trying to build in Metro's portfolio is more diversified portfolios. And so I think given where we are in market valuations, it's kind of prudent to be diversified. Slide 8 just shows you what's been driving some of these returns and markets and what we've been seeing so far. And this shows you representation of the earnings growth of the SP 500. If you look at the green bar, it shows you the calendar year returns, the calendar year earnings growth estimates for 2026, up 24%. So really strong earnings growth. And then estimates for next year are up 17%. And a lot of that's being driven by positive outlook from AI tech-related names, but also energy. We're actually seeing that broadening out to other companies within the market as well. And then lastly, just a look at valuations on slide 9. As I mentioned, we're near all-time highs, particularly within the large cap stocks, but we do see some better valuations in international markets and then small cap stocks as well. So I want to pause there, see if there's any questions before I pass it off to Adam.
Yeah. Given the concentrated weight of those top 10 stocks, is it your expectation that those top 10 will continue then to drive the whole S&P like the index funds?
Yeah, so I think what we're seeing so far, particularly is in July, we did see a rotation away from some of those names. And so in July, we actually saw a drawdown in some of those names that we mentioned. Not to say that's going to be if that's the trend going forward, but I think we get to a point in terms of valuations where you see a lot of this euphoria in markets and it's very concentrated. We go back to different eras, .com era particularly. So it may not be those same names, I think, that are the winners today. You might see that broadening out going forward. So at least for now, we have seen some of that just concentration of ETFs and index funds driving valuations higher.
So Dave, I think it would be fair to say that you probably see a transition from the S&P, which is highly rated in tech, back to the Dow, which isn't so concentrated.
Yeah, I think you see broaden out to like more value-oriented names, yeah.
Dr. Walker has his hand. He's on the screen.
Oh, sorry, Dr. Walker.
He's like, where is he?
He's
an
AI.
He's really small up there. Okay.
Right.
Dr. Walker, go on.
A corollary kind of, I guess, what everybody is asking, what is the concern of a quote unquote AI bubble? If this goes the other way, how hard would it hit us?
Yeah, so the AI bubble is a great question. It's something that we've continued to evaluate. But what we've seen, I think of the one slide I wanted to show you, the previous slide 8, just talks about there's actual true earnings growth behind the AI bubble and the build out here. So you can see here, earnings expectations continue to grow with real dollars. And so you're actually seeing capital investment. So the hyperscalers, think of the Googles of the world, are expected to spend $800 billion this year alone and the build out of AI. And so there's actually real investment behind some of these earnings and multiples growth. But I think the way that we want to make sure that for your portfolio is being diversified and not only focused on the highest valuation names, but also focus on some of the other companies that aren't directly, you would say AI, but are benefiting from the, this AI revolution.
I think previously you had, oh, sorry, Dr. Walker, go ahead.
Oh, I just said thank you, that's all.
You had indicated that the fact that these big tech companies are shifting more to debt to finance that growth is something to watch. What are you thinking about that at this moment?
Yeah, so you see some of the, like I mentioned, some of the growth, the supply within the corporate bond market, you see the financing of the AI build is growing, supply is growing. That's something we want to continue to watch. You see a lot of these tech names had a lot of free cash flows or cash in their balance sheet. And now they're saying, hey, we need to spend as much as possible to keep up on this kind of AI race. And so you have seen, particularly within the bond market, some pressure for interest rates rising just because we have seen heavy supply out there from some of these AI names.
And I presume you're gonna, when you talk about fixed income, you're gonna circle back to those bond prices, right?
Yes, absolutely. We're gonna spend some more time on that as well.
Okay, I'll pick up here. Thank you. If you go to the next section. Yes, one more, please. So as we sit here today, June 30th, as we take a look at the investment policy, also the Ohio Revised Code rules that apply to the system, everything is within compliance. And these are the quick checks on that. I'll skip slide 12 and go to slide 13. You know, one of the things we started a couple years back was this watch list concept. And that's just another layer of monitoring of the individual investments. And here we're focused on, as we look at the investment managers, there's quantitative things that we can see quarter to quarter, year to year. There's also qualitative aspects. So those guidelines are captured here in slide 13. Then I'll quickly go into slide 14. And this is the watch list. The top part of the page is focused on qualitative things, and on the bottom is quantitative, which is just performance against benchmark and peers. So there's two strategies that, and David alluded to this, that we want to draw the committee's attention to. The first one is actually very simple. One of your investments is called Transamerica International Equity, and it's sub-advised by a group called TS&W. And what we've been notified of recently is Transamerica is changing the sub-advisor. So essentially, it's going to be a totally different managed strategy that we are not close with the new group that's taking over. So basically, it's a whole different team. And that's an easy one. Usually these aren't so easy, but we would like to make a change to that strategy for that reason. The other strategy is a group called Vanguard International Growth, and it has two sub-advisors. The larger of the two sub-advisors is a group called Bailey Gifford. We've seen some changes to their team also, not a full-scale change to the team, but some of the portfolio managers. They've lost some assets, so that's a concern. They've also had a lot of performance inconsistency. So we would also like to make a change to that strategy. And both, by the way, are being flagged on this watch list criteria. So keep that in mind because we're going to come back to this here in just a couple of minutes. So I'm going to move into performance before we get to those international manager changes. So if you go to slide 16, this is the total system snapshot. And the reason that this is put together, it's tying together the assets that Clearstead's reporting on to your total balance sheet of investments. So on the lower half of the page, you had 362 million in the reserve pool. 300 is the minimum requirement, so you're within that, you're above 300. And then the non-reserve pool is at 347 million. That includes the captive assets. So altogether at 709 million. On the next page is the system investments performance-wise. So for the quarter, we'll talk about dollars here in a moment, but the system investments were up 5% for the quarter, which brings the year-to-date up to 4%. So you had a small loss in the first quarter. Within that 5%, the non-reserve long-term pool, that's where you have all of your equity exposure, is up almost 15% in the quarter. And the non-reserve short-term pool was up 90 basis points, and then your reserve pool was up 40 basis points. If you go to the following page, just break that down in dollar terms. So highlighted on the bottom of the page in the second quarter, the investment change was positive in the system portfolio, 22 million. So that brings the year-to-date to positive 17 million after the $4 million loss in the first quarter. That 450 million in the lower right-hand corner is a reminder that does not include cash and also the captive investments to get you to that 700 million. So strong results to report there. And then on slide 19 is the captive update. So the captive investments were up $9.2 million in the quarter. So collectively, because it all falls under the same Metro Health balance sheet, your total investments were up $31 million for the quarter when you include the captive. Any questions on any of the performance before I talk about the international equity managers?
How frequently do you rebalance?
So this committee has the sole authority to rebalance the portfolio. So anytime, we're in communication with Jeff and Christina and Nick. And if something were very pressing, we would bring it to the board to this committee between meetings, but it would be at your discretion to rebalance the portfolio.
So John, how often?
We balance like at least annually, sometimes
Yeah.
twice a year. Especially if something goes way up. And then we took money off the table last year and put some more money in bonds. So we constantly watch that and,
So one of the things that we, if I could jump in here, one of the things that we are looking at, and it's not on the agenda for this meeting, but I think we want to put it on the agenda for next meeting, is to re-examine our investment policy. I asked James to look into kind of the restrictions that we have from the county and what restrictions we have under ORC, and whether it's time to have a policy that gives us more flexibility in line with what other not-for-profit hospitals do. So that's just to tell you right now, we're just looking at that. So we'll come back with our thoughts and recommendations on that. And obviously John himself is an expert in this area, so we'll talk.
So as you recall, 300 million has to be, totally out of the market, safe.
Yeah, as is the case with municipal governments, everybody.
Yeah. Well, we actually had to go, we went to the counties, we got a specific, because we're Ohio Revised Code, but before the county demanded us come to them and present it, and they actually put parameters on us. So we could, I'm not saying we could go to the county and ask them to reduce that.
Does the state of Ohio still have those Star Ohio funds that?
They got the county treasurer in trouble years back. Remember that?
The ORC requirement is 25%, so that's a law. We have to have 25% in safe investments, but the county restrictions could be changed upon our request, and that's something we'll have to look into.
Not saying we should,
So,
we just.
Right, no, I get it, yeah.
Sorry.
can I ask a question?
Yeah, oh, yeah.
Yeah, I'm sorry.
Okay, so as I understand this, our earnings just for the 6-month window are 4%, our returns, correct?
Correct.
That was at the top of an earlier. Okay, so I saw it correctly. And then we're talking about all these restrictions we have, county, there's always a lot of stuff. Do you have a way to illustrate to us what our performance was against benchmarks, given whatever these restrictions may be on our investments? Because to the extent we're saddled with this, and I stand with, I believe it was Jeff Rooney talking before, to try to find ways to be, to have more wingspan, if you will. But, how did we actually do against what we were allowed to do? And was 4% a good number, a great number, or did it fall short? And that's probably nothing you'd have for right now, but
Yeah,
it would
it's
seem
in
to be
there.
that.
It's in there.
Well,
Yes,
then help me-
equities versus S&P and the down.
Then help me understand, maybe I'm trying to keep track of all the slides changing, but help me understand how we did against the world in which we have to live.
Yeah, so I think there's two parts to your question. So if you go back to slide 17.
Okay, can you on the screen, please?
Yeah, that should be coming through now. So the portion of your portfolio where you can take more risk is that non-reserved long-term pool in the top right-hand corner.
Right.
So your
correct.
results in that portion year to date were up 10.5%. The long-term pool benchmark is simply a combination of US, because you have a split between US and non-US stocks.
Okay, I see that
So-
now. Okay,
See that?
so we fell short
Now-
then, right?
A little bit short, and some of that has to do with sort of the broad or the narrowness of the market that David was touching on, and we're seeing a rotation of that. So you're a little bit behind, and we're looking to make some changes within your international equity portfolio. The other part of your question around the high revised or the county restrictions or high revised code restrictions, like what that might have cost the system, like that's something we'll have to think a little harder about. I would say most long-term pools that we see year to date are up in the range of 6 to 8%. But I think we got to be a little bit careful that these are reserves. It's not a long-term foundation or endowment. So even without restrictions, it's probably going to lean a little bit more conservative than some of those types of pools. But given the restrictions, we think you've participated pretty nicely with markets. The other thing that David would hit on is one of the benefits that we haven't talked about is yields have all increased across the yield curve. And the fact that the system has a lot of cash and short-term fixed income, that will be a net benefit just from the way that the portfolio is positioned. And you're going to earn more on your short-term fixed income and cash in our estimate in the next few years.
So I think very quickly, two things. Number one, you show the detail, which is helpful below. It would be nice to see a number that would roll all that up, all the benchmarks up to say that, the benchmarks were 3.5 or 4.2. That's really the bottom line number. The second thing is where we did fall short, and it's only, granted, it's only $21 million, but if you look at it analytically, we fell short on the international pretty significantly, almost, 3.5, 4 points. So that to me would bear, and I think you said something, but I'm just trying to get an understanding, and also for a longer period of time, of how we've performed given the constraints. And maybe that's something we could do in the interim and give to John Moss or whomever to show over the past 3 to 5 years what the performance has been.
And they are making a recommendation. They move out of the Vanguard International, which has not performed, which has kind of hurt our international performance.
Okay. Well,
So, John, I'm on a state board for the Conservancy District, and they have the same restrictions, but they're strictly Ohio revised code restrictions. And their performance is actually slightly below Adams, but the amount of money invested is probably maybe 60% of what Metro has invested. So they're about 0.15%. Their earnings for the same period are 4.15% lower than this, just for comparison of a like-for-like organization.
Thanks. Any other quick questions before we move on?
I guess I'd rather compare myself to someone that did better,
No, I don't disagree. We can talk, I can talk to John offline. So we took a different tack. We actually worked on revising legislative language to move a portion of the pool into a foundation. So, and that doesn't have the restriction, but it took us 18 months of work at the state level to get legislation passed to allow us to move the money. Yeah, but we were able to do it. So, but that now that becomes more complex on how you manage the money, because now it's outside of the organization.
So our path of least resistance, maybe, is going to the county and getting them to lift that 3.
Yeah, but this is, even if you got rid of the county, this restriction's still in play.
25%,
But the ORC restriction is not onerous. We keep that much.
No, but I'm saying, but this is fully.
Yeah,
What I'm looking at on this report, this investment report that I'm looking at, this meeting was August 21st, so it was only a week ago. I went and looked at the investment report to see how that performed compared to what Adam's reporting, and I'm saying Adam's report actually shows a little bit higher earnings, investment earnings than another like entity from the state. That's a compliment, John.
I'm not right. But I think I'm a little worried about the bull market where people say, we are going to be putting more in the stock market. So anyway, in a bear market, it was the other way.
Yeah.
Don't forget, when things go down 50%, you need 100% to get back even. So
Yeah.
just, we can go down that path, but just be careful, you know.
Discussion for another.
I tell these guys, it's like the nineties all over.
Yeah.
And I remind that 1996, Alan Greenspan, longest serving Fed chairman ever, said we're in a, this is irrational exuberance. We need to, he called the dot-com bubble, all the way that. After he said it, the S&P doubled and the NASDAQ tripled. So, you know, he's a smart guy, and I was an idiot and listened to him. So,
Okay. Yeah. Well, if you go to page 20, we want to get to the recommendations for the committee. So we talked about our concerns with your two international positions, and the recommendations that we had to replace them are one that's an active position, meaning it's a strategy that's trying to beat the market, and the other is a passive position. So the strategy we're recommending that's active is called Harbor International Core. It's sub-advised by a group, and there's a lot of information that will follow here that I'll leave with the committee. But it's sub-advised by a group out of Boston called Acadian Asset Management. They have a strong track record, very good reputation. This is a much more diversified portfolio. I think about 600 positions. It's a quantitative approach. So they're using big data to find mispricings in the market, trends. Their models have been very successful also with market momentum. That's just something that's difficult with fundamental managers. And it's kind of down the middle of the fairway in terms of its exposure to the market. We think it's an excellent solution. So we like to pair that with the Vanguard FTSE All World ex-US Index. So half passive, half active. This does reduce the overall fees a little bit, and we think better positions the portfolio. So what follows these next couple of pages is just more supporting information on Harbor. And then we have, which is on the following slide, and then slides 22, 23, 24, just it's supporting performance information. And I guess let me pause there, but I want to get to the recommendations. Does anybody have any questions about those?
Question. What was the pool of I guess, of international managers that before you narrowed it down to these two? How big was the overall pool of, candidates that you were looking at to replace these two managers?
Yeah, so we, our research team, thank you for asking, our research team, literally scours the landscape. There would be hundreds of international managers. And this wasn't a search done just for this replacement. So the strategies that we were evaluating would be ones that we know and have already approved and vetted. So there's probably a dozen international strategies that are approved on our platform by our research team. And then we worked with the team to decide that these two would be most fitting for the Metro portfolio.
Okay, thank you.
No, I don't think we did, right? Chief, we don't think we need a approval vote.
I would think so, yeah, you're changing your, yeah,
They're changing something.
yeah, I think
Okay,
it's a voice
Yeah.
vote.
right, so,
If you go to the next page, this captures all of the movements in the portfolio. So maybe I'll explain what this is showing, and then I'll turn it back to you, John. But this is a snapshot through August 18th. Market values are up a little bit. So between the system and captive, the investments are up an additional $6 to $8 million in the third quarter. So good news there. You're also above the 300 million in the reserve pool. The recommendations we have are in the center of this schedule, and that's replacing the Vanguard and Transamerica funds with Harbor and Vanguard Index. In addition to those changes, you've also accumulated some dividends into cash from your other investments. That's the $2 million down towards the bottom of that change column. And we simply want to reinvest that into the Vanguard 500. It all stays within the same non-reserve long-term pool. So those are the recommendations we have for the committee.
so I'm gonna ask for a motion to approve the recommendations made by Clearstead to move out of a couple of the mutual funds and into some new better performing mutual funds.
So moved.
Second. Take a whisper.
All those in favor?
Aye.
Any
Aye.
opposed? Any absent? Okay, motion passes. Thank you. I'm gonna move on. Thank you, Blake, Mr. Blake and Mr. Strickland. Thank you for all that. There's nothing else, right? Done?
There's some informational items, but nothing that the committee
We
needs
gotta-
to
we
take
gotta
action.
move on. Thank you.
Thank you.
This time we're going to move in executive session, discuss hospital trade secrets as defined by ORC 13333.61.
Gotta do-
We're not there yet. We're only
I'm
on
sorry,
B.
I'm sorry.
You're going over to
Finance.
Christina Morales
Yeah,
and
okay.
Jeff Rooney.
Going to,
The 2020 second quarter
Second quarter.
okay.
financial.
We'll turn over to Mr. Rooney and Ms. Morales to give us
What
update.
I would ask is we're going to delve into our financial statements in more detail and talk about some of the challenges we're having this year and we'll talk later in the meeting about some of the challenges we see next year. So we can hold some of our questions until executive sessions and some of those more detailed questions, we'd appreciate it.
Great, next slide. Okay, so we'll start with kind of a high level financial summary. And as the committee will remember, we had kind of a slow start to the year, right? So health system, we always have a little bit of seasonality here. First quarter starts slow and we really kind of pick up in the second quarter and into the third quarter as the summer months approach and we have our trauma seasons. This Q1 in 2026 was, I would say, a little slower than our usual slowness. Just a light flu season. We did have some weather disruptions that closed sites a handful of days. And so what we're happy to report is that, you know, the beginning of the second quarter really kind of started the same, right? April was sort of similarly trended to the first couple of months. But as we got closer and into July and into June, and then we're gonna talk about July in executive session, we really started to see that pick up. So that happy to report that. So we ended the second quarter with a $53.1 million operating income. We did beat budget, and that brought us to the $37.6 million operating income figure as we look at year to date. So you can see we were running behind and we made up some ground in the second quarter. I'll highlight a few key volume items. So there's overall volumes lagged, but again, I mentioned if we looked at just the month of June and as we go in and look at the month of July, you'll see the pickup. You know, one of the things is prescription volumes. If you look at prescription volumes on this slide, it looks like it's lagging to budget. I do want to call out, you know, originally we anticipated that OPHC was going to open earlier in the year. And with that, we have this 24-hour pharmacy drive-through, which is fabulous. You know, we expected some of those volumes to start materializing by the time we got to the second quarter. So the delay in opening that building actually did impact some of what these volumes look like to budget. But I'll show you in a few slides, actually, we did have strong pharmacy performance as far as script fills go. So I just want to call that out because it's a little misleading on this slide. Okay, next. Okay, so a few of our key performance indicators. I'm actually going to start at the bottom. So case mix, for those who aren't familiar with case mix, this is really a measure of the acuity of our patients, right? So the level of required care for our patients, we were below where we expected to be in terms of acuity. And so when you look up at the top sections of, you know, revenue per workday, some of that was impacted by that lower acuity. But otherwise, you know, supplies as a percent of operating revenue, labor as a percent of operating revenue, continued that trend of being well controlled so far this year. And we are beating where we expected to be from a budgetary standpoint.
Kristen, what, for a 0.1 reduction in case mix, what's the reduction in reimbursement?
I used to know-
I just wanted,
I was gonna say,
I used to know that.
No, the reason being is, so, you know, those who don't know,
It's a big deal.
it's a big deal when,
Yes.
so it may not seem like a lot, 1.92 down to 1.89, there is a big drop in reimbursement from Medicare when you see a drop like that. So it's not a small change, it's actually a large change. And you know, you have efforts related to, you know, doing scraping the medical record, looking for opportunity to improve documentation, which will result in a higher case mix. I'm just making sure, as I see this, you know, that's a concern related to reduction in acuity, because it then trails reimbursement for the institution. So you could be meeting your, you know, your volume, inpatients per calendar day, but if your case mix index is down, you're still gonna be losing money. Or reducing, I don't want to say losing money, you're gonna reduce your revenue. So two together, is it like a double whammy? If you're missing your inpatient volume and you're missing your
Exponential.
well, I don't know if it's exponential, it could be logarithm, that guy.
There's a dollar number you.
I was doing it more for discussion
Yeah,
purposes.
no,
for-
it's true. We'll talk
You
about-
see it, Christine, and that's how your brain thinks, but I just want to make sure that's how my brain thinks. I just want to
Yes.
make sure the rest of the board, when they see that, they're thinking the same thing. That when they see that, it's like, okay, so what changed, you know? So anyways,
That'll
sorry.
be
No,
rel-
thank you for that.
That'll be relevant for the budget process too,
Mhm.
obviously, because you can see we actually budgeted at a number less than we had last year. We're still not hitting that. So we'll get that and we'll bring that the next meeting.
Changes in casements capture on billings.
Well, I think one of the things we are short on this year is surgeries. So this would definitely reflect on, we had some highly productive surgeons who had left Metro Health, and surgery volumes are down, medical volumes are up. This would be a direct reflection of that, for sure. Doug wanted to add in, I don't see Doug, something.
Oh, yeah.
Sorry.
I'll go to the next slide. This is just a graphical representation for your reference of some of the metrics we just went through. So I'm going to actually pick up and go to the next slide. Okay, so operating statistics. So I know these are small and there's a lot of colors happening here, but there's some good content kind of underneath the surface. So discharges, overall, our discharges have improved about 5% compared to last year. So we, again, saw the pickup in June, discharge numbers are up. Overall, our visit volumes are down about 12,000 compared to prior year. But if we look under the surface, our in-person clinic visits are actually up. And where we're seeing the reduction is in telehealth. So from a reimbursement standpoint, although it looks like some of our volumes are down on the clinic side, not a huge revenue impact, because really clinic visits drive a lot of the reimbursement on the outpatient side versus like a telehealth reimbursement. Surgical volumes, again, inpatient surgical volumes were strong, up 4% from last year, 6% to budget. That was a concerted effort by management and some of the strategies we deployed. So we're happy to see some positive improvement in our inpatient surgical volumes. And prescriptions, this is where I was kind of mentioning on the last slide. So prescriptions are actually up 5% to last year. That blue line represents our capture rate. So what that means is for every script that a Metro Health doc writes, you know, how many of them do we fill at our pharmacies? And so we have had from this time last year until now, an almost 5% improvement in the ability to fill the scripts at our pharmacies that our docs are writing. So again, deploying pharmacy strategies to help capture more of these scripts, which really helps to improve reimbursement. So next slide. Payer mix. Okay, so this is a snapshot of our payer mix. Where are we at as of June year to date compared to where we were at for last year? Similar trend to actually what we were talking about in Q1, and this is another area we're going to talk about more when we get into executive session. But you know, the pattern that we saw at the beginning of the year has really continued here. So we are seeing the biggest drop in the commercial bucket, which is our folks that are falling off of coverage through the health exchange. There was a reduction in subsidy dollars this year, and so you know, folks did not renew their insurance, and that is a national trend. And a lot of that has just gone straight to self-pay and those presenting without coverage.
And I saw you indicate 9,000 people have lost their, do we have any estimate for what that loss is going to be in 2027?
We have some estimates around the loss for Medicaid coverage next year. I don't know that we've modeled out the health exchange, but our estimates right now are in the $15 to $16 million range. I'm gonna skip again, next slide, and then one more.
And we're gonna get a chance to look at this again in executive
Yes, I've
session.
got
It's a little
more.
more depth
Yeah.
and so.
Don't worry, there's always more here. So, okay, so operating revenue detail. So kind of the volume numbers we just talked about combined with some of the payer mix information leads us to, what's happening within net patient revenue and overall operating revenue. So, excluding our supplementals, our net patient revenue is behind to budget. It is also behind to last year by about 15 million. Some of that is really payer mix driven. If we look down at the hospital additional payment and hospital state directed payment, which is kind of in that middle section there, I'll just call out a couple of things. So originally when we budgeted, we expected the HAP program, which we've had for years, it was enhanced last year through some additional funding. So when we originally budgeted it, we expected it to be worth about $185 million for the year. Subsequently, that a new model came out and our amount actually dropped to about 140-ish million for the year. So you'll see there's a little bit of a deficit there to the budget, but nice improvement over last year. We are getting more dollars through this program this year. On the state directed payment line, that's that middle line, we call it the canoe. We have recognized $94 million through June. One thing I really want to call out here. So when we closed the year, we knew about the enhanced HAP dollars before we finished our audit, right? So we recorded 25's portion in 25. With respect to the hospital state directed payment, we did not find out about 25 until audit was closed, year was over. And so we actually recorded 6 months of last year in this year. So that 94 million is richer by about $60 million because of 25 amounts. So when we get into some of the presentations in executive session, we're going to talk about how that's going to level out in the budget next year. We've just got the advantage of about 1.5 years this year. Anything you wanted to add on that one?
No, I think that it's a nice gift and we will realize some cash when they get around to giving us the cash. So we're showing it here, but we actually haven't received that cash yet. So we're patiently awaiting the cash for that. So.
And no one's more excited than Nick. I'm not sure where he's sitting in the room, but I'll get there. Okay, the last thing I want to call out. So the very bottom line in the deduction section here is called settlements. What that line represents is if we need to reserve any of our supplemental dollars, or if we have any cost reports or other filings from prior years that we ultimately think are going to settle. So we didn't get as much money as we should have, or we got more than we should have. That's what runs through this line. And you'll see there's about a $3 million settlement recognition. That is because we looked at the payer mix. We saw some of the Medicaid volumes are dropping. Our self-pay is increasing, and we've got this new supplemental money. So all of those things together, we anticipate and model out that we're not going to be able to retain all of the supplemental dollars that we're getting. So what we're starting to do here is, as we record it, we're immediately reserving it under the assumption that we think we're going to have to pay some of those dollars back. So I want to call it out because it looks small now. We are going to continue this reserve through the end of the year. And by the time we get to year end, we're going to be in the $20 to $25 million range here. Okay, next slide. Actually, so this is our balance sheet. Honestly, it was an uneventful second quarter. So I'm going to skip over this because most of the fun stuff happened within investments in cash, which we're going to talk about on the next slide. Yes.
Is the settlements, is it a contra revenue or is it really just an expense? How should I think about that?
It can really go either direction. So if we think that we filed a cost report or something and we say, hey, we had way more bad debts than we were paid for, and we think that the government owes us money, that will actually be a positive number. If we think we owe money back, it will be a negative number. So it swings.
I understand.
Yes.
Okay.
Yeah. Unfortunately, this year it's the negative swing. Okay, so cash and investments. We mentioned some of the 2025 dollars that we benefited from the enhancement of the programs. Those came in the second quarter. So a nice bump here in cash. Our days cash on hand, which we're going to talk about on the next slide. Rose about 4 days. So that might not seem like a huge number, but we talk about every day is worth about $6 million around here. So this is a nice improvement in our cash balance. Our requirement for our bond requirement for our days cash on hand is 75 days. So we are at 123, which means we're nice and healthy above that covenant requirement. Same thing on the debt service coverage side. Our requirement is a 1. We are currently at a 4.8, and that's really, healthy operating performance is really how it helps to boost this metric.
Back to the balance sheet, because it's page 54,
Sure.
net pension liability.
Yeah. Oh, boy.
The state of Ohio, we're in their programs, right?
We are.
So, and isn't Ohio at about 65% funded or in that range? Do I remember that?
I actually think it's higher, a little higher than that, but you're correct if where you're going is that this really represents Metro Health's portion of the state's underfunding of the OPERS plan.
35% roughly.
Yeah, yep. And I haven't looked at it this year, but we do this adjustment annually. And what I will tell you is if you look at the whole state, and we can bring this to the board in the fall, and you look at Metro Health compared to all the public employers in the state, right? So every municipality, every university that's public, right? We are actually, I think last time I looked at it, like on the member directed side, we're almost 13% of all of OPERS. And on the pension side, it's a little less, but we are one of the top 2 employers in the state. So when that pension fund is underfunded, like we really bear a lot of that on our balance sheet.
But we don't,
There's no legal liability. This is purely a governmental accounting standards excitement. Everyone else will call it. You love it.
I don't know if I would use that term, but
It generates questions like yours, Mike, but there's no actual consequence.
Yes, thank you.
They're shaped in most states.
Yes,
Yes.
yeah.
New York, Illinois, California, other states have a local jurisdiction responsibility of pension obligation.
And if you look at some of the other pension plans, even like the state teachers retirement pension or OP&F, like OPERS is even better funded than some of the other state plans, so.
So we're counting on Ohio to do its job.
That's right.
We are.
Okay. Any more questions on the balance sheet? Okay. We'll skip ahead a couple. One more. Okay, so this is a lot of numbers, but pay attention to the colors because this is very positive. So what this does is take Metro Health's benchmarks and looks at them against where we are with respect to our peer group in the rating agencies. And so a lot of green on this page, which is really positive. Where you see the red is really on some of the debt metrics. And, we have the 2017 bonds. That was a significant debt load when the system, took those out. Actually, Dr. Alexander, Jeff, and Nick and I were just in our first rating agency call for the year last week, and we had trended the last handful of years and how we were performing on some of these metrics. And what's really nice to see is actually the system has grown. Our balance sheet has grown, our asset position has grown, and we've continued to pay down our debt. So although these are red, we as a system continue to pay down our debt and bolster our position, which is really nice to see over the last handful of years. So, yeah.
Jeff, in a previous meeting, we talked about exploring refinancing some of this debt. I imagine that's a little trickier conversation at this moment.
we want to save that for.
Yeah, let's save
executive
that
session.
for.
Yeah. Good question.
Yeah.
Executive session.
I think this is the last.
Okay, yep, next slide. And that is the last one. So capital budget summary. So again, we looked at this one last quarter. So this just tracks our annual capital budget and where we are at with respect to committing projects, starting projects, and getting them moving. Even with the opening of OPHC a little delayed from where we expected it to be, we have continued to push forward with our capital initiatives for the year. So we're halfway through the year. We are about halfway through our budget amount. So we're exactly where we expect to be. And one item I'll call out, if you look at some of the sub detail on the bottom, is you'll notice the strategy bucket is still not had a lot of dollars spent. This is the typical pattern with the strategy bucket, right? So we look at initiatives, we put business cases together, we bring those forward, and then the latter half of the year where we start to figure out, okay, yes, these business cases make sense, we're gonna approve them, there's a healthy margin here, those dollars start to get committed. So that will, in the third and fourth quarter, we'll see some of that money get drawn down and level out. Yeah.
So the balances are still, I mean, a lot of dollars haven't been tapped. So at what point do you realign the spend? So you've got, 55.4% in clinical equipment, the balance remaining. Are those committed? Are they waiting for the people to decide what they're gonna get? I mean, and again, it's more of a rhetorical question for Christine as you push through the year, or John, are they carrying over to the next year in the balance sheet? I mean, so do they spend, what percent of the balance usually spend? You can answer offline. I'm just saying, it's September, so you're almost.
Yes, this is second
This is through
quarter.
June. This is through June. So we've made more
You think
progress on
You think
this.
it's, okay, you think it's gonna,
So what would it be today?
I don't have that number right off the top of my head, but I will tell you this. We meet quarterly. We go through all the buckets and we look at what's out there. Sometimes it's a matter of, we had like 10 little projects move forward in the first half of the year, and there's one big guy that's
you're gonna be close to
Yes.
80%, 85%?
yeah.
So,
Oh, I'm
I
sorry.
mean, from a clinical equipment perspective, we will spend it all this year. So
Okay.
one of the other things we have to think about is we were opening up OPHC. A lot of that capital equipment was assigned to that project. But now we're really third quarter opening things up. And we have some big projects that are coming through. We have a pool of about 4 million for just break and fix that we don't plan. We want to kind of spread that out evenly through each quarter, so we don't get into a bind at the end of the year.
Yeah, so if we were looking at this at the committed part, I think that's what you're talking, because
Yeah.
the spent, we get to the committed part's only 7 million. Right now, that would be a much bigger number.
Should be a
if we
big-
were
much
doing-
bigger
if we
number.
were doing this today.
The proof's in the year-end close. I'll remember that question for year-end close.
I have a spreadsheet that actually tracks it, so
I don't think you're gonna.
we'll be ready.
All right.
Yeah, so the other thing I'll add is, just for definition purposes, the spent means money's out the door, we've paid the invoices. Committed means we've already issued purchase orders, right? We're moving forward with these projects. We just haven't either received the item yet or spent, like the invoices haven't come in, we haven't spent it. So spent and committed together are what's actually kind of occurred to date. Allocated means the project was this big and you've only gotten this far with it, kind of a thing. So just for definitional purposes. So that's all I have on this. Any other questions before we move into executive session?
We'll take those quite a lot of questions in executive session too. So if, with that, if you don't mind, I'm gonna move on into executive session. We're going to move into executive session to discuss hospital trade secrets as defined in ORC 1333.61. Do I have a motion to recess into executive session to discuss these matters? So move. Do I have a second?
Second,
I'm gonna do a roll call. Artis?
Yes.
Ron?
Yes.
Me, yes. Harry?
yes.
Okay, we are moving into executive session. And I'm gonna ask this public to step out.
Okay, now.
Okay, if there's no further business, this meeting is adjourned. Thank you very much.
This 101.